So in this module, let us take up this accounting equations subject. This accounting equation forms the basis for the entire accounting activity. The equation is very simple. It just says assets equals liabilities plus owner's equity. This simple equation, I repeat, forms the basis for entire accounting activity. So let us learn this in detail in this module. So let me start with the meaning. Assets, nothing but what the business owns. Liabilities, what the business owes to others or outsiders. Owner's equity, what the business owes to owners. So if you look at the entire equation, the left side talks about what the business owns and the right side talks about what the business owes. So when we say business owes, one, it can be to outsiders, another, it can be to its own owners. Can we sense the concept of separate entity here? Even though owner has given the money and owner is starting the business, when we look things from business angle, we say business owes so much of money to owner. This is what business entity or separate entity concept is. Owner is different from business. Now, having said this is the simple equation, for our own understanding purpose, we will develop this further. Assume a business has got 100 crores worth of assets. So when a business claims it has 100 crores worth of assets, a person like me will get a question first of all in our mind, from where this business got 100 crores worth of money to acquire 100 crores worth of assets. Probably they would have borrowed 40 crores from outside, say from a bank or from a financial institution. The other 60 crores would have come from owners, meaning owner would have given or owners would have given 60 crores capital. So by taking 40 crores from outsiders, by taking 60 crores from owners, the business has got 100 crores of money with which it has acquired 100 crores worth of assets. Always the left side of the equation should match the right side of the equation. So now the simple question, compulsorily should we have liabilities? Not necessarily. Maybe entire 100 crores should have been given by owners also. Compulsorily, whether owner's equity should be there? Yeah, logically speaking, unless owner gives some money, who else will give money to start the business? So there can be so many businesses without liabilities, but we can't see businesses without owner's equity. So coming back, left side of the equation, assets equals right side of the equation, liabilities plus owner's equity. Now let me develop this equation. Assets equals liabilities plus capital minus drawings. That means in place of this owner's equity, I am bringing in two new jargons, capital, drawings. And by now you can understand owner's equity is nothing but capital minus drawings. So what we mean by the term capital? The amount invested by the owner or owners, depending upon is it a sole proprietorship or partnership or company form of business. So the amount given by the owner to the business we call as capital. Then what is drawings? The reverse. The amount drawn by the owners out of the capital invested by them. So the owner would have given 10 crores, would have taken back 2 crores. At the end, the balance 8 crores is what we call as owner's equity. Let me repeat. Owner would have given 10 crores, would have taken back 2 crores. The resultant 8 crores is what we call as owner's equity. And there is one point to mention here. Drawings are permitted only in sole proprietorship and partnership business. Drawings are prohibited in company form of business. Please remember this very clearly. Now, having said this, let us move further. Assets equals liabilities plus capital minus drawings. Assume you run the business for say 1 year. At the end of the year, how this equation will change? Assets equals liabilities plus capital minus drawings plus profit. You may ask me, in case the company has not made profits or suffered losses, what will happen? The opposite. Instead of writing plus profit, we will write minus loss. In a very rare case where you have no profit, no loss, then the previous equation stays. That's all. So coming again, assume you run the business for say 1 year. At the end of the year, you have profits. Then how this equation will change? Assets equals liabilities plus capital minus drawings plus profit. To whom this profit belongs to? This profit belongs to owner. That is why profit is added with this capital minus drawings. In case of loss, this will be deducted from capital minus drawings. So let us define the profit now. We have already seen it in the previous modules. Excess of income over expenses, and it belongs to owners. Fine. How to develop this further now? Let me explain the term profit here. So assets equals liabilities plus capital minus drawings plus income minus expenses. So this very clearly says that any income gets added and any expenses gets deducted. Now, having got the profit, what are we going to do? Let me develop this now. Assets equals liabilities plus capital minus drawings plus income minus expense minus dividends. So what do you mean by the term dividends? The amount given by owners as a share in the profits, or amount given to owners as a share in the profits. So dividends are nothing but a share in the profits given to the owners. As it is given, we are deducting this because no more the business owes this money to owners. But in case of loss, obviously there is nothing to share, so there won't be any dividends. Thank you.